Hi everyone, welcome to Call of the Week episode 4. This is my weekly YouTube program on the stock markets, what happened in the previous week, how things are placed today, and what the future holds for us. Now, in these episodes, I cover various aspects of global developments as well as domestic developments and try to correlate that into forming a view about the markets. For those of you who saw my last episode, you would have seen that I was pretty negative on the markets and I used the word risk a lot of times in that video. And that risk was inbuilt in the markets. And typically, what happens is that when the scenario builds in a manner where you think markets are overbought, too many positives are put in, and complacency has set in, we need to be cautious. After the event has happened, turning cautious makes no sense, and that's what we did in the previous week. So the Nifty fell by around 550 points this week, which was a substantial sell-off. Markets fell each day of the week and continued to make new lows for the near term. Now, the trigger for that was obviously Donald Trump's tweets on imposition of tariffs on China, which created an immediate sell-off in the markets, and then that got accelerated because of various factors which played out. The trade war is the most important thing to track at this stage, and I'll spend some time talking about that. Now, the US markets did not fall as much as people would have thought they would because of the imposition of tariffs. But that doesn't matter because we should not just see a few days to form a view that markets have factored everything in. That it's not that way. There's a significant escalation in the tariff war, the trade war, and it will have repercussions going forward. Now, the negative impact as far as the US is concerned will be more on what these tariffs do to the overall inflation in the US, because the US is a huge consumption economy and China is a huge exporter of products to the US. 25% of all Chinese exports go to the US, and to that extent the US does not have immediate replacements of many of the products it buys from China. So there will definitely be some impact on inflation because of this increase in tariffs on $200 billion of products from 10% to 25%, and how that is looked at in the context of an economy where employment is at all-time lows and wages are moving up, although at a pace which was low, which has been slightly lower than expectations, is something to be seen. So do not discount what happened in the people try to form a view based on what happened on Friday. It's not that way. We have to take a longer term view, and this entire trade spread doesn't look as good. It's even more negative for China because for China the exports to the US are very significant, and the Chinese economy has been slowing down in any case. So in a slowing economy, this sort of hit is very difficult to take, and I think we'll see significant negatives for the Chinese economy because of this. And if the trade deal doesn't happen over the next few weeks, and there's a further imposition of tariffs on another $300 billion of exports out of China to the US, then the impact will become more negative. Now, in conclusion, just on this topic, I would say that both sides actually want a deal to happen, but given the fact that the differences have grown so much and China has utilized the entire loopholes in various in the way the entire trade scenario worked globally for so long, that someone had to take it up to them. Donald Trump has taken that, and it will take some time to resolve. But it will have some negatives. On the flip side, it will have some positives for other countries. So other countries which can immediately replace China in the various supply chains, which could include economies like Vietnam, some of the other Asian economies, and also India to some extent, they will tend to benefit, and we need to evaluate that as far as evaluating which are the companies in India which could benefit because of that. I've been talking to some companies, and many companies have indicated that in many of the sectors, some of the Chinese companies themselves are looking to put up supply base in India so that the exports are shown out of India rather than China, and this could be a phenomenon which will gain steam going forward. Now coming back to the Indian markets, a lot of companies reported results this week. Last week, many consumption companies had reported weak numbers. Hindustan Unilever came out with numbers which were pretty decent in the overall context of what the consumption pattern in the economy has been, and it's an outperforming stock to that extent. Uh, Among the other larger companies which reported were Bharti Airtel, where there seems to be some sort of recovery setting in, but it's not very significant to create a significant upside. State Bank of India came out with results on Friday. Results were well received by the market, but the provisions continue to be very high. The slippages continue to be extremely high, and like Reliance, when it came out, it was taken quite positively, and then people realized what are the risks. I think something similar could happen with SBI also, because uh, the capital adequacy, although enough for currently, will fall short if credit growth continues, and they'll need to raise capital. And every year we have seen PSU Bank chairman come out and say that the worst is over, but the worst doesn't seem to be over. So this is something which we'll also watch out for to see how it plays out. Aisha Motors also came out with results yesterday. On Friday, results were pretty decent in the context of what the expectations were. The valuations of the stock have fallen substantially over the years, and it will be interesting to see how this stock behaves. Looks to be coming into some sort of value zone if they are able to deliver on whatever they are planning for going forward. HCL Tech was the other large cap which reported, so numbers were okay, but the outlook was not so great. There is margin pressure coming through in the IT sector, and that's something which is going to weigh on the sector going forward. IT is one sector which I think has some headwinds going for it, so we need to be slightly cautious. The mid cap side saw a large number of companies come out with results. Some of the fancy mid caps came out and actually delivered results which were below expectation. This includes companies like VIP Industries, Volta, Supreme Industries, etc. Now the point is that the results are a reflection of what's happening in the economy, and the economy has been slowing down significantly over the last 3-4 months, and that is getting reflected in the numbers of many of these mid-cap companies. However, many of the companies, these companies and others, will bounce back significantly as the economy recovers going forward into the second half. So the correction as it plays out will be an opportunity to buy in these stocks. The liquidity crisis in the economy continues to be very high. The liquidity crunch continues. RBI's strategy on handling liquidity is very, very tough to understand in an economy which has slowed down so much, where liquidity is a constraint. Significant liquidity needs to be put in the markets. RBI has always had a strategy of keeping the liquidity in deficit. I think we need a liquidity which is in surplus, so that the economy can, because unless there is liquidity and money circulates, the economy comes to a standstill. And let's see what happens after the elections, but right now the economy is in a slowdown mode. Last 3-4 months has seen the slowdown actually get accelerated because government spending has slowed down. Corporate capex is as it is weak, and the infrastructure investments have slowed down, and consumption demand seems to have just collapsed for some reason. So this was also reflected in the IIP numbers which came out on Friday, where there was virtually no growth for March. So the capital goods impact output was shown as -8.7%. So across the board there was weakness, and this is something which the new government will need to address. As far as other things go, crude prices, despite the kind of volatility in the markets and sell-off, remains stable because of the supply constraints which are coming up due to Iran sanctions, what's happening in Venezuela, as well as Libya issues. So the OPEC plus meeting, which is happening end of May, will have to be carefully watched, because unless there is some supply response, this kind of Spot market oil shortage can lead to a spike, which is not good for emerging markets at a time when there are various factors contributing to a slowdown. From the context of what lies ahead, I don't believe that the entire impact of the trade wars and whatever has happened and the breakdown in talks is reflected in the markets currently. So we will see the markets sell off a bit more going forward. From the Indian context, the markets have fallen 550 odd points, so maybe a few hundred points more of correction is possible. There could be some bounce back because markets have fallen 8 days at a trot. So, but that bounce back could be further sold into, because one of the key parameters I watch in the markets, which is the Nifty 500 plus minus 2 spot put call ratio, that still continues to be in an uncomfortable zone, which shows that so it's somewhat technical, but which shows that put writers are more confident than call writers, which essentially implies that traders are still positive. So until traders start becoming a bit negative, the market bottom will not be formed. So, but it will eventually be formed, but it will happen over the next few days or next because next Sunday is a very important day when the exit polls will be held and the exit poll numbers will come out. So if the poll numbers turn out to be positive, then markets could start factoring that in. This week could be a week where we could see a market bottom forming, but for that the market still needs to go down a bit more. So let's see how that happens. Most people tend to become negative when market falls 10% from the top. That's not the time to become negative, because when market falls 10% from the top, unless it's the start of a bear market, which is not my base case at all, then it's actually an opportunity to buy rather than sell. So we are waiting for that. From the trading perspective, obviously we were negative on the markets, and those calls paid off for us. I would still be more on the negative side rather than positive for the absolute short term. Post elections, we are obviously going to see a V-shaped recovery in the economy and the markets if there is a stable government's formation, and we are ready for that, and we are in the process. We have already identified the kind of stocks which should be bought, and there are a large number of companies which have corrected significantly. So I think there lies the opportunity in the market. So that's all I had to say this week in Call of the Week. Next week should be more interesting, and next video I'll put up after the exit polls on Sunday rather than on Sunday morning, because that event we need to factor into our views. So thank you very much for watching. In case you like my video, please like it, and if you like my channel, please subscribe to it. Thank you and bye.